Global trade uncertainty shifting policy out of Washington has sent gold on a record-breaking run. But with the tone changing in recent days around possible talks with China, have the fundamentals changed for the precious metal? Joining us now to discuss is Bart Melek, Global Head of Commodity Strategy at TD Securities. Bart, always great to have you on the show.
Oh, it's wonderful to be back.
Things can change so fast, right? I mean, what was it, a day or two ago, we were just discussing the discussion we were planning to have on this show. Gold has moved south, in a sizable move just in 24 hours. It just, to me, it sort of speaks to the volatility. What are we thinking about these moves in gold?
Well, I think, for one, we will continue to see volatility. Certainly policy doesn't seem to be, a nice, steady move towards a particular goal. It seems a little erratic from time to time. Just on Tuesday, we've seen gold touch $3,500, so an all-time record yet again. We've seen corrections prior to that, and then we've seen several things happen. One, of course, there was a big risk off a few days, and gold tends to do better when there's a lack of confidence in risk assets broadly. And then, of course, we had the U.S. president be quite vocal about disagreeing with Mr. Jerome Powell, the Fed chairman, about policy. The president suggested he would like to see lower rates faster and maybe deeper cuts than what the Fed is prepared, and certainly from the market's point of view, after a series of executive orders on a variety of economic determinants like tariffs, the market wasn't quite sure what to do, so it bought gold. We've seen a bit of a crisis earlier in the treasury market with one of the Japanese banks selling treasuries, looking for liquidity, and that was the first pullback in the very aggressive rhetoric on tariffs from the White House. And it seems to me that this, for now, will be somewhat of a negative for gold. And today, gold is off. I think last time I checked, a few seconds before coming on here,
about 4% on my screen right now.
Yeah, so off about $100 or so.
3,300, yeah.
Yeah, so we're off, but ultimately, to your question, fundamentals have not changed. Even if we see some sort of a negotiation with China, I think much of the damage has been done. We are going to be seeing disruptions on the supply chain. We are seeing U.S. inventories of a lot of imported goods from China in particular erode. We'll likely see significantly higher inflation. In fact, the Federal Reserve is talking about 2.8% inflation, their favorite core indicator, the PCE. We're looking at other forecasters looking at close to 4% at year end. So there is a lot of inflation out there, and the market continues to think we're going to have a slowdown in the U.S. economy in particular. In fact, organizations like IMF, who typically are a little bit late to the party with these forecasts, are all saying that we're going to see a slower economy. And at the same time, as we're seeing inflation inflect higher in the United States, in particular, we're likely going to see a Federal Reserve that is adding monetary accommodation. Certainly, they stopped, cutting the balance sheet down, and certainly market is pricing, I think, at this point, 3 cuts by the Fed. So a combination of inflation moving higher and a Fed that is catering to the second part of their mandate under the Federal Reserve Act, which is maximum employment, would suggest that gold still has very solid fundamentals. Other big factor is central banks.
I wanted to talk to you about that because I'm looking at a one-year chart of gold on my screen right now, and obviously it's been a big move just in the past month, and April has been the tariff month, but you look over the past year, and before Trump was in office, gold was on the move. Before Trump started talking seriously about tariffs, gold was on the move, and you've told us for some time the central banks, the day-to-day change, the central bank's desire, it seems to want to be into gold more so than U.S. dollars?
I don't think so. I think when central banks make a decision, it is a strategic, long-term decision to diversify their assets. And they've been doing just that. In 2022, we've seen central banks, or the official sector, if you like, which includes other institutions that are part of usually government entities or government sovereign funds, have been loading up on gold. In 2022, they bought well over 1,000 tons. In 23 as well. In 24 as well. And this year looks like it's going to be very strong gold buying year as well. And they're moving into gold for a variety of reasons. One is, of course, they're worried about the some $37 trillion of U.S. debt outstanding, and they are quite worried that the U.S. may have problems funding that debt, particularly if we see a tariff regime that limits the amount of dollars a lot of these foreign investors get. I think the deal was you give goods to the U.S. and then U.S. gives you dollars and then you buy the debt. And the U.S. debt is continuing to grow at an alarmingly fast pace, 6% plus. Maybe it'll even be significantly higher if this administration cuts taxes. Further, if it extends the current tax regime, and we see more tax cuts, and it's unlikely that we're going to see big increases in revenue from tariffs, particularly if they are being whittled down right now. And plus, you can't do both, right? You can't cut deficits and cut taxes all at the same time. So there's a bit of a conflict here, and that's the worry. The concern here is that over the long term, the U.S. may have to de facto monetize some of that debt, and that can be done in many ways. One is, of course, central bank buys it, and that would ultimately mean that long-term rates are kept artificially low by government interference. And there is the issue of maybe the U.S. Treasury market having a significant competitor in the form of Eurobonds. Now, Euro is, Germany in particular, is discovering deficits and deficit spending again. They are trying to rearm independently of the United States, and that could very well mean that in the next, few years, in a year, I don't know what the timelines exactly will be, is looking at trillions of potential Eurobond issuance, which would directly compete with treasuries, and then you're in a situation where the market, foreign market, is already strapped for buying all the treasuries potentially, and then you have a viable competitor in the form of Eurobonds. And what do? Well, you may think the world will trade around the United States, and the U.S. dollar may not be as relevant in the global economic system as time goes on. And typically there's an inverse relationship between the U.S. dollar and gold. So investors are worried, and central banks, that we could see erosion of purchasing power. There's also the geopolitical factor as well.
Gold touches on so many things.
Gold touches on so many things. You might want to buy gold because you're worried you might get sanctions, as Russia has when it invaded Ukraine. In no way, I will reiterate, am I projecting or forecasting, some sort of an issue with Taiwan when it comes to, military interaction from China. But I think as trade relationships sour, these tensions will, I think, increasingly arise.